structure and a few key points and notes, and to go over market maker models, and then in general just be like showing examples on the charts and just talking through how I see them.
Perfect. Maybe as you go along, you can share, copy, and just send over the charts that you're using into the chat so I can copy them to my notes.
Yeah, we'll do. So yeah, I was going to try and make it like make it really, really well structured, and have know exactly where I was going to go for each part of the lesson or like the presentation, but that would take like a bunch of time of organizing it, and I figured that it's probably best just to just go through the basic framework I've got, and then yeah, so it won't be as structured as I'd like it to be. Like I'd love it to be like a really nicely put out presentation, but it's going to be more me just talking through the stuff that I am looking at and just answering any questions you might have. So
Sweet.
I'll share my
That's
screen.
perfect.
So can you see that?
Oh, whoops. Yep, there we go.
Sweet. Yeah, so this is what I started writing up for notes of just how I want to structure the lesson. As you can see, I've got a bit down. I've got a bunch of examples that I've written out that we can go and look at. But I mean, market maker models are everywhere, so you can really just pick them out of the chart. But yeah, so I'll just I've got another copy up on another window, but I'll just start going through this. So to start with,
Wait,
yeah,
before you start, would it be easier if I asked you questions first and then you answer them and then you can get into it? Or
yeah, it's not a bad idea. We can yeah, go ahead. If you've got a question, just throw it at me, and
just,
I'll yeah.
just vaguely, because I know that market maker models are just like a framework to look at how they're delivering price and stuff. But my question is like, okay, how do I actually like know, you know what I mean? Like you in
Yeah,
price, you can see an order block. It's a pattern. Like you
yeah,
can look at the candles and it's a pattern. You can recognize it. A fair value gap, it's a pattern. That's obviously like how can you actually spot a market maker model, and then how do you actually like how can you prove that that's, I don't know, how do you even
yeah,
use it?
yeah. Sweet. I can go over that for sure. And okay, I'll start with like just drawing out the really basic framework, and we'll really quickly get into how to know that it is a market maker model and where it's going, and how to recognize it, as just like you were saying. So, but I'll start off like with the stuff you probably already know, but I'll start off with like a consolidation, and then you'll have a stage of, I mean, on the way down, it's usually called distribution, but it's also accumulation if it's a market maker buy model, accumulation of buy orders. But first stage, second stage, you have a smart money reversal, a shift, and a first stage of a reaccumulation, which will have a short-term low and intermediate term low, and then another short-term low, and then you'll have second stage to terminus. So that's kind of it's a bit not the cleanest looking, but the really basic framework is you have a original consolidation. You have typically two stages on the way down. You have the smart money reversal into a key high time frame PD array, and then you'll have first stage, which will always consist of a short term low and then a intermediate term low. So that's the key is RTL. So you always have an intermediate term low, and as long as you can recognize that, and then you can look for the short term low to the right of it. And then when you're approaching the terminus, which will be usually there'll be original consolidation. Above that, you'll have a an old high or something. It's like a previous day high and it falls just short of it, and then we'll start the model into a fair value gap. So let's say this is a retracement. You'd have an impulsive leg here, for example. It falls just short of whatever your high time frame PD array is, and then this would be the low time frame retracement. So the low time frame market maker buy model and a high time frame retracement before hitting the draw. After the first stage, once you recognize that, then you can anticipate second stage will be next, obviously, because after 1 is 2. And when you are approaching the draw and liquidity and the top quadrant of the range, that's when you want to see speed into the draw. So with the speed comes second stage, which is usually an institutional order flow entry drill, which is a partial entry into a fair value gap. Or you can also use any other PD arrays that will be likely to, you'd expect speed from. So another one would be if we had, for example, the RTL drop down like this, had a short-term low here, and then you can say, okay, well this is the order block. This is the order block that dug into the order block. So this is our propulsion block. Yeah, and so this is where you want to use propulsion blocks because you're already anticipating speed. You could recognize the first stage of accumulation, or I'll just say first stage and second stage because you're distributing as well. But yeah, you've already recognized first stage. You're expecting second stage, you're expecting speed. Propulsion block and IFD are both PD arrays that you expect speed from. So that's when you really want to see something like that happen. As far as your question goes with how do you know that it is one, how can you actually recognize? So obviously you're already really good, I know, at high time frame PD arrays and knowing the draw and where price is going. But basically, once you have an idea like we've got here, where okay, we think it's going up to this liquidity pool, we have a PD array we're expecting a bounce from, and it hits that PD array and gets a reaction off of it. So that's when you're going to be looking for your SMT and whatever else there is, and that's how you confirm when it's where you expect it to bounce from, it does bounce, and it's got SMT, and then you're just trusting that that is indeed correct. And then once
does that ITL, is that what always forms the SMT, or can it be into that
it can be this
initial
way.
delivery down into there?
It can be there. This will be, I'll show you some examples that, because I was actually looking at this week, it's actually quite interesting how they'll be timed differently. So one will make a low like this, and then the other asset might make the low all the way over here, while this one's in a different phase of distribution. But yeah, so it doesn't really matter as far as I know what makes the SMT, but as long as you recognize the SMT, so it can be like that. And yeah, then you're just looking for the first stage. First stage. So this is what.
So the way that you use it, because my problem is it's just like so vague when I first learned about it, but now I'm guessing that the way that you really want to use it is not necessarily to be like, oh, this is this whole market maker model, I recognize this pattern. It's more about just identifying which stage we're in, because then you can change the way that you're looking for your trade entry.
Exactly. So
you're like, I'm looking for the delivery and the start of the first stage.
This is all I need.
Setup.
Yeah, exactly.
And now you know to look for that hard time frame PD array to be traded into to buy or whatever. And then once we've already had that and we have SMT at the lows, now you're looking for that second stage entry, and then just entries into the second stage as we go along.
Pretty much, yeah. So all I need to trade it is that. All I need is the right side of the curve. The left side can be used, but you as long as you can recognize this and it's at the right time of day. So let's say this is 9:30 here. I'll show you. This is a really cool one. I'll show you some examples. Let's say this is 9:30 and it just expands. And let's say there's nothing over the left. We're at all-time highs. There's nothing over here. then as we're expanding, you can still recognize these same characteristics of a short-term, intermediate, short-term IOFD. And
Oh, yeah,
so,
just a fractal
yeah, and
thing.
so let's say, we then get to the next day and you aren't sure what price is going to do. Obviously, you have to build the left side before the right side, and the left side has its own characteristics. Like once you break away from original consolidation, there'll be original consolidation retest, which is where you get your order block entry, but it doesn't have to either. It could not retest. And then you have the same kind of characteristics on the left side of the curve. But if you are, let's say you're engineering a market maker sell model, so you would be leaving behind, so that's another way to recognize it, is if you're engineering a market maker sell model, you'll be leaving behind kind of smooth lows on the left side of the curve. Like you might be doing that for first stage. And then for second stage, it might do that. And then that's another way to recognize, okay, this looks like I'm anticipating us to reverse up here somewhere. And I can recognize we have all these smooth lows in here, smooth lows down here. And that's probably the best way to recognize a full market maker model with both sides of the curve is you just want to be looking for where's the smooth liquidity, where are the smooth pulls, and then you're just waiting for the right time of day to attack them. And
Dude,
then, yeah,
dude, that's exactly what Nasdaq looks like right now. Is this
yeah,
to me?
exactly, yeah. And like once you start like looking at it and seeing it more and more, it starts just sticking out everywhere, and it really helps with being able to trade it. This week on YM, I was using a lot of this, and it was just working so good. I was really happy with how it was working, but just using the really basic framework to trade it. So the next thing I'll mention is on the way back down. Let's say you got your smart money reversal. You'll be using you once we get
So
below these pools, we tend to stay
when you
below them.
say, wait, when you say smart money reversal, people always say that, and I don't get like why that's even a term. What does it even mean?
Because smart money are going to be getting in at the smart money reversal. Like if you want to sell the top at an all-time high, that's what smart money is doing, I guess. I don't know, but
But why don't they just call it the reversal
I don't
or
know why it's
the
called smart money reversal, but it's just how IGT like what he called it. So, but yeah,
how do you recognize it though? Like what
SMT and a high time frame PD array. The main thing is just a PD array, like a high time frame PD array, and then obviously you're going to have a market structure shift. This is the 2022 model, market structure shift with displacement.
okay. Okay.
So once you're on the right side of the curve, you're looking for us to remain below below whatever side of the first and second stage on the left side of the curve, or whatever pools there are. So there's a down closing range on this side. You wouldn't want us to come back above that because that's not showing you quite what you're looking for. And then you'd be looking for, as we work our way down, once we get below each of these pools, you want to stay below it. And we don't have to take out the original consolidation. So it can be perfectly smooth lows, but what can happen is you can work your way down, and then it wants to reaccumulate in this area, and then shoot up and make another high. So that's also a thing, and that's basically a retracement and then continuation. So let's see. So I'll go back. I'll quickly look at what I wrote for what I want to talk about. So we've gone through the basic framework, high time frame PD arrays and SMT, retracement or reversal. So it can either be a retracement like this or a full-on reversal. PD arrays. So I'll just put all that back. PD arrays, we did some of them. Obviously, you've got the change in state of delivery here. You're going to be able to grab, so I'll redraw these. So on the left side of the curve, you're going to have fair value gaps, so SIBIs. You draw those across, and you can use those as entry points. And then you've also got the mitigation blocks, like that. You got the breaker block here. And then on the right side of the curve, you have obviously whatever forms in here. So there could be a fair value gap, order block, propulsion block, IOFED, just whatever you want to use. But then this is like a really helpful thing. As I mentioned before, just talking about how when you're anticipating a different speed of delivery of price, you're also going to be looking for different PD arrays. So the main example being the second stage, if you're expecting speed, you're expecting IOFED, or you're expecting a propulsion block or some PD array that will give you speed.
Okay.
So that's a really key thing that you'd want to,
That's
make
what
a
I've
note of.
noticed. I really struggle with that last stage delivery because my model just doesn't ever form. But I always end up trading like those bottoms, the reversals, and that IT internal. What does ITL mean?
Intermediate term.
Oh, intermediate term. Yeah. So I always end up trading that first intermediate term low and the reversal, and then once it's like exploding away, I never catch that unless I'm just holding a runner for like forever.
So this is where the next note that's like a gem will come in, is in a market maker buy model, there is always at least two stages of accumulation. In the market maker sell model, there can just be one, and that's usually when it's a really fast move. But in a market maker buy model, there's always at least two. So if you are expecting, I'll show you right here. This is a beautiful example. This is the markup I did the other day. Got a lot of signatures that can show you, but hitting some sort of high time frame PD array to the left. During these examples, I'm going to just have the assumption that we already know the narrative and draw, and just using benefit of hindsight for everything basically. But so smooth highs up here. That's where we're going. We have a smart money reversal down here. Will be some SMT with silver. So what can you see here?
Came back and trade back into the order block
This order block here,
and soup those equal lows while it did that.
like that.
Yeah.
Yeah, exactly. So this we'll call as the first stage. We have smart money reversal. Somewhere in here, I guess you could call that low risk buy. Then you have a short term low here, a intermediate term low, another short term.
Where would you, using that low risk buy, that's where I've seen so many entries, but I'm just too scared because I don't know where to put my stop without having a massive stop.
Well, so this is getting a bit off topic, but it's it's low risk buy is obviously if you know, let's say you've got a fair value gap here, and you can tell that we like just cut outside the line. We didn't close past CE, and you're like 95% confident that this is the smart money reversal. That's when you want to be buying. That's when you're going to be buying down here. That's where you're going to be down here when you're confident. And when you're confident, depending on the narrative and what's happening, also on the higher time frame, like as to what kind of speed you're expecting, then you can, and what time of day it is. Obviously, if it's in Asia, you might continue down here a bit and then move away. If it's, let's say this is the 9:30 open, then you're probably going to rip up here, and then you're going to get a low risk buy all the way up here and then rip up. But
how would you this is off topic, but the low risk buy, how do you frame your risk? Where would you put your stop loss?
Well, it depends on the situation. And I know as good as you, but for this one, I'll be looking at this as a balanced price range, and theoretically it shouldn't go past CE. But you'd be like, well, if it comes back down here, then I'm wrong. So you'd put your stop down there. But Yeah, that's not.
I'm just curious because you mentioned in the market maker model where when it reaches into that pool of liquidity, it shouldn't trade back above that whatever level. I can't remember what it's called.
Yes, so that's in general, that's like the textbook example, but obviously it's not textbook in real life, and that's what makes it so difficult for people to learn is that we don't have like a picture perfect model. You don't often get them.
Well, like
But
look if you look at let me share my screen just so you know what I'm talking about.
yeah, but
Because
I'll just
I
continue with this example for now because I get what you're saying about that, but we'll just focus on like the really basic framework of it for now, and then you'll get the hang of it the more examples like I show.
okay.
Yeah, so here we have a short-term low, we have an intermediate term low, we have a short-term low to the right of it. So we can confirm that as first stage. And after
A
first,
soup and then another soup. It's all just it's a fractal, and you should be getting SMTs into all of these, right?
yeah, there'll be SMT like all over the place. And then obviously this is a fractal market maker buy model that fell short of the draw, it dropped down and reaccumulated. But so we've got short term low, intermediate, short term low to the right. And then this is where it gets interesting, where you've got the second stage and how I was mentioning how you're using different PD arrays. So the first thing that's giving you a clue is we have a breakaway gap for the new week opening gap. That's automatically telling you that it is like really strong, really bullish. We then have this large displacement up here. You're already anticipating this to be left partly open because we've had first stage, we know the draws up here, and we're looking for a second stage. So you draw out the fair value gap, and you're already expecting part of it to stay unfilled, which happens right here. We
Man, yeah,
will leave
dude, this
CE.
is so helpful, dude.
And then,
Dude, if I get the hang of this, this is gonna completely change. Because that's my problem. I'm like, man, there's so much it can rebalance. I don't know when to like. You want to buy at a discount, but it's like
yeah,
I want to get a better entry, and how do I know how deep
exactly.
it's gonna go? Because
So,
sometimes it creates SMT, but it leaves such a big range that if you did enter, your stop would have to be like a 1-to-1,
yeah. So
risk
that's
reward.
where watching and taking note of how strong the order flow is important. So here we can see
Yeah.
we've got a really clear breakaway gap, new week
And
opening gap.
and
So
what
that's
stage we're in.
yeah. So this is telling you that we are really bullish. We then don't fully fill this in, so really bullish. We then only fill in we barely touch CE of this fair value gap, really bullish. So then we can go, okay, well, we've had first stage, we're looking for second stage. We've already had IOPD on the higher time frame, but we haven't displaced yet. So if you drop to a low time frame, you go, okay, well, it's shown me that it's respecting CE. Now we're having another market maker model in here. We've got the smart money reversal. We've got a short term low.
Accumulation.
We've got a RTL and a short term
Wow.
low to the right.
That's
Okay,
crazy.
so
That's
if
so
this is
clean, dude.
so if this is first
Holy cow.
stage, then we're looking for second stage after. For second
And it does the
stage,
exact same shit
yeah,
again.
you're looking for IOPD.
Holy
The
cow.
cool thing about this one is that for this IOPD, I'm just going to make up a high time frame fair value gap here. There is one, but it's just to prove it.
Dang. Dude, we should have recorded this.
I'm recording it just in case it's handy. But yeah,
Oh,
drop
sweet.
it down to 5 minutes. So we know. So this is where it gets really cool, where it's fractal. We know we've had this one reversal. This is first stage. This is second stage. And then you're dropping down to the 5 minutes. You're going, okay, if this is second stage, it's already showing us that it's respecting the IOPD as we expected. It's already showing us first stage of second stage. And now this is the key part. This is second stage of second stage. So you've got institutional order entry drill and then a huge move. And when you can recognize that this being a low time frame market maker model and you're expecting IFD already, then that's when you can like anticipates that it should just expand in one direction to your draw.
Dang,
And
yeah, that's crazy. That's like, because I've studied a lot of things before I got into ICT, like Wyckoff and Elliott wave, and that's why I was drawn to those, is because I was like, cool, like there's like a structure I can look for instead of just kind of like shooting blind,
yeah,
like just using like the price action candles or fair value gaps and displacement.
yeah, and
This
having
this is like so clean because I'll just be doing my normal analysis, and then all I'd have to do is just re-look at what I'm looking at, but then put it in the framework of, okay, what is the market maker models here, and that's gonna like give me that that's like the missing conviction I feel like I have
yeah,
to to get into these trades, and just,
that's what's
and also
useful about
the opposite,
yeah.
knowing when to wait and to like wait for the second accumulation or whatever.
Yeah, so that's where yeah, having a framework is real handy because it lets you like anticipate where you should see speeds, where you should see a certain entry versus another one. Like over here, you wouldn't be like, oh, smart no reversal, I'm going to do an IOFD and expect it to move all the way up. You'd be waiting for, okay, I'm waiting for, we've made a short term low, I'm expecting this or this to get taken out, and and sure enough, it does. And then once it's expanding, you can do the same kind of thing where, I mean, in this case, you have like a consolidation through this range in here. And then you have the breakout of the consolidation. And because it's all balanced in here, you're expecting the midpoint to stay intact. And then sure enough, that's like the original consolidation retest slash a consolidation, order block entry, expansion. Yeah, so that's one example on gold. I'll see if I can find another one on gold because there was another one that I quite liked a little while ago. Let's see. Where are we? Hold up. Looking at this. Similar kind of thing here. So I'll go to a slightly higher time frame. So let's say obviously it's been a retracement and now we're going to expand back out. So just really, really basic labeling. With the benefit of hindsight, you got your short-term low, intermediate, short-term low, IOFD expansion. And when you start just like framing it up like this, it kind of makes it a bit easier to just not be too demanding on it has to look picture perfect. Like, wait, where's the original consolidation up here and the first stage and the second stage? When you just know, okay, well, we've hit this pool of liquidity down here, so we've hit our high time frame PD array, and I'm trusting that this to be the smart reversal. I can see we've put in a first stage and had displacement, and now we've engineered a short-term low to the right of it, and we're moving towards the draw, and then you have your second stage, which is the IOFD that you're expecting. I'll just look back at my notes and see what I wanted to talk about. So we talk about PD arrays, saying below, one depth, first stage, second stage. Yeah, so pay attention to the order flow strength in order to anticipate what each stage will look like. Example, strong order flow, anticipated IOFD. Weak order flow, anticipate high resistance conditions, and may also get a change in state of delivery before reaching the draw on liquidity. And there is a example, NQU, so buy side delivery fails, market maker buy model to reaccumulate below the first stage. So NQU 2024, 28th. UU 28th of the 8th. I think that's in here somewhere. There we go. I'll just go back to here. What was I talking about? I think I must have been talking about the 29th. But yeah, it'll be this probably. Was it? NQU 28th of the 8th.
Wait, so right here, this is where I like would struggle with the whole market maker model, is because we have that move down, and theoretically that's the reversal, right? And then that next reaccumulation, move down before that on the smaller time frame, that little order block, propulsion block type thing. No. Lower after the move down.
After move down, yeah. So you got
that. It's hard for me to be like, okay, that's accumulation, and then it's like, okay, that's the second stage, but then we end up getting that next big move down again, taking out that.
So this is
that little order block.
This is the example I was wanting to talk about. For some reason, I had it written down as the 28th, but this is actually the 30th of August. But so the points I wanted to bring up, the nuance is that you want to pay attention to the order flow strength in order to anticipate what each stage will look like, and also what we're actually going to do. So in this case, does this look like, right here, does this look like strong or weak order flow? I mean, like strength as in wanting to go down.
Yeah, strength to the downside.
We have a breakaway gap here. We have really crisp respect of this order block, not even getting past the open, displacement, and it easily hits this original consolidation down here. However, to the right, does this look like it's got much strength?
Yeah, so
leaving relatively lows, really deep retracements, fully filling in order blocks. So
that's when the whole way up.
Yeah, so that's when you're thinking, okay, well, sure, I'm bullish because I think it's going up here for some reason, but it's not showing me the signatures of strength. And like I mentioned before, it doesn't have to take out the original consolidation. It can drop down. It can just go there to reaccumulate, whatever. So when you're seeing this and you see, okay, well, like we're nearing the draw, but it's getting really high resistance, then you want to be anticipating that it might not be. So then what do we have here? We've got, just ignoring like really fine detail, we have a first stage here, got a short-term low, intermediate, short-term low, and then all this delivery up through here. In this case, we have an original consolidation, first stage, we lose momentum, we're not wanting to move, we're just really high resistance, and then we drop back down below the first stage to reaccumulate and then deliver. So then you can, if we look at this model one here, so it will be quite a nice clean one. We've just dropped into a really nice pool. I'll just zoom out a bit. So a nice pull down here. There was S&T, I think, with Asia lows maybe. Then you can do the exact same thing as before and just really basic go, okay, there's your first stage. And then after the first stage, we want to see...
wouldn't that be like the low risk entry?
So I'm never too sure exactly what it's meant to look like. I think because as I mentioned before, it is kind of vague. Like you do have like the clear stages, like a first stage here and a second stage here with an IFED. but it's not always like absolute textbook clean. So like how I'd do it would be say smart run reversal, low risk buy here somewhere, first stage, second stage, terminus. Kind of, not trying to
Yeah,
be
that's.
too
I'm
exact.
just trying to find that little holy grail of the, because I've seen this so many times where it makes the, I know that it's probably the low, and it's like that's where the higher time frame like entry
Well,
on a long term like
technically you'd be
trade would
you'd be
be.
saying, okay, well this is the low risk buy right
Unless
here. You've got smart run reversal, the change in state of delivery, low risk buy. Like sure you can do that, but that's when you want to be knowing, okay, I know it's turning here because of all these reasons. But in general, you just want to be looking at like you have the first stage, and then you have a partial drop into this fair value gap for second stage. And in this case, we fall short of the draw, and this is where reaccumulation comes in. So I might as well talk about reaccumulation now because there's a nice example. But it's basically falls short of the draw, drops back onto a order block, and then delivers. The nicest example of that is on RTY U. And that is in here. So in this case, drawn liquidity can be this previous day high up here. And then we have our relative equal highs, and then I'll drop down to a lower time frame. So we have this original, like this market maker model in through here. After doing this market maker model, we don't quite hit our drawn liquidity. Instead of hitting where we think price is going, it drops back into the range. So when it drops back into the range, then you're looking for a order block to buy and to send you up to your draw. So fall short of the draw because end of the day, it's kind of PM session, not enough time left to get there. And then you're just looking for an order block. I think there's a nice 1 minute order block on this wick to reaccumulate before and then get delivery to the draw. And ICT's talked about this being the easiest trade you can get. Like when it falls short of the draw and just drops back into an order block. It's like the easiest trade of all trades.
Dude, I've seen this happen so many times, dude, and I don't know how to trade it. That's
so
cool.
It's just if it falls short of the draw and drops back into an order block, you just buy it. But the example I was thinking of, this is looking. Oh, I see. I'm rewinded. I was just thinking, like, how do you not recognize this? Okay, here we go. So, where was it? I think it was in here. Here we go. Found it. So in this example here, we have a really clear draw. We have a order block, a fair value gap up here, and we don't hit the fair value gap. We literally come up to it and we fall short. And knowing that when price delivers, it doesn't just go for liquidity, it will go to the inefficiency above it. Got perfect equal highs up there as well. So when you see that happen, you can be like, okay, well we're looking for reaccumulation. And then you're just looking down, okay, we've got a propulsion block here. And there's your reaccumulation to the draw. So dropping down to this time frame, you can see the same thing playing
seems
out.
like that offers really consistent, easy, but lower R trades that are just like 2-3 R, easy, quick,
Well, that's
works in like 15 minutes.
Not necessarily. It can be really high R. And in this
on
case,
like the intraday, yeah.
Yeah, but the main thing is that it's a really easy, obvious trade where we obviously didn't hit where we're going. Like we're clearly going higher than that. We didn't come up here to leave another relative equal high and make a low low. And then you look down here, you say, well, this is all balancing through here. And I can explain why real quick. So obviously we've got, this will be probably some SMT here. We took a nice pull of sell
Dude,
side.
this is actually what a lot of my fair value gobbles are, because we have that propulsion block you see, which
Yeah.
creates the inversion fair value gap, and then we create that first order block inside of that, and then we create relative equal lows. Do you see those relative equal lows after we
Yeah,
get out of the BPR? Yeah. And then we get the soup of that into the order block.
Yeah, so
Boom.
that, like I did a
That's
markup
literally
of this chart because I actually called this trade. That's why I can remember it so well. Um, but yeah, when you recognize like, okay, we've got say order block here. So obviously we've got we've got this order block. Then we have the order block that digs into it. I suppose this is also within it. It's another kind of propulsion block kind of thing. But this entire range essentially is very, very, very well balanced. So we're not going past midpoint, that's for sure. This is a propulsion block, so we're not going past midpoint into that. And then when you know that, then you can easily frame risk with your stop below the midpoint of the propulsion.
Yeah, that is such an easy trade. That's like, I'm totally gonna keep this in mind. The untapped lows that didn't get delivered into. That is a whole new easy thing to look for. Holy cow!
Yeah,
I've seen that a billion times, and I'm like, man, like I just never know how. Like I know it's gonna go up while I know it's pulling back, but I know it's still gonna go back up. I just don't know where or how to get in, because it's just like I don't know if it's gonna come all the way back down to like that original fucking order block that souped the whole range. Like I don't know if it's gonna take out that open candle low and then do it. Like I've never known how to do that. You know, or like had conviction to know. But that kind of adds that missing link.
When I see like a low just engineered above a really obvious order block, and especially if it's relative equal, that always means that like that's the order block's really high probability. Like when we engineer a short term high just below a change in state and then leave it and then come back, a lot of time that's it. But then also just recognizing, that this is a propulsion block, or that this range in here we've painted backwards and forwards inside of this range a lot, so this is balanced, so midpoint won't be taken out. But yeah,
Dude, damn, this is good.
Yeah, I'm glad you're like it's getting across what I'm looking at. The next thing is important to talk about is second stage in alignment with time. So like I was mentioning before, how second stage you can anticipate what PD arrays you'll expect because it's going to be fast. So you're going to expect propulsion block, IOFD. The same things with time. If it's second stage, then it's likely going to be happening around 8:30 or 9:30 when you're expecting a lot of speed in the market. The best way to put that will be in QU. There's a lot of good examples in here, I believe. So second stage in alignment with time. First, I'll break down this real quick. So we have a higher time frame, obviously, market maker model here. We have a short-term high, intermediate, short-term high, and then displacement, and then IFED inside this range. So I already drew this out before, but yeah, you've got a fair value gap, doesn't reach midpoint, and then sells off from there. So going back, we'll start with this example here is really obvious. We have second stage, like within this higher time frame market maker model, where we've had the first stage here, and then displacement low, and then we've got this like fair value gap that we're expecting midpoint of, and then we're looking for speed out of there. So if I don't need to do that actually. Do I? I might need to actually. I'll just replay to here. Okay, so a lot of the time you're expecting a fast move from 930. And when you can identify where it is in alignment with a high time frame model, then you can expect like, okay, if we start to see like the displacement from here, then we can expect that to continue. You've also got the same characteristics as I mentioned earlier, where instead of looking for like a market maker model really close, that's really obvious. If you're expecting speed from here because we're nearing a key pool of liquidity, or we're delivering from a high time for a market maker model like this, then you've got the same thing where it expands from 930, and then you've got your first stage. You've got a short-term high there, you've got an IOPD there, and delivers to the key liquidity pool within the higher time frame market maker sell model. Sorry, I was getting a bit messy with how I'm trying to explain things. But you have like the same thing here. We have a first stage of first stage here. Got a short term high to the left, intermediate term high, a short term high to the right, and then at the same time we've got this fractal where we've got a smart reversal here, a short term high here, an intermediate term high, intermediate or short term, but once we break down, then we're looking for a short term high to the right of it. And when that aligns with time of day, being 9:30, then you can expect that to be the distribution leg for first stage. Just trying to. This is a better example actually. This is a lot clearer, a lot easier to see. So we've got our smart money reversal up the top here. We have our short-term high, intermediate term high, and then this is assuming that we know everything in advance. We're not questioning anything, and we're just professional about everything. There's a short-term high here somewhere. Let's say that, and let's say we're trusting that because we know that it's really heavy. There's also a way to anticipate how big the move is going to be. Is if we fail to have a deep retracement, if we're leaving all these huge breakaway gaps, we're unable to fill this, we're leaving all this unfilled, that's telling you that we're extra weak. And that's when you would be expecting, okay, we are likely to see a really big move. Then when you have that and we've had first stage, I'm looking for second stage, we're approaching 9:30. 9:30 is represented by the yellow candle, by the way. And then you've got your IOFD and like second stage of distribution at 9:30 open, which is when you're expecting speed anyway. And because we've just had this huge like inefficiency left open, we've also got this high time frame inefficiency that we never got above the midpoint of. So it's showing you plenty of signs that it is very bearish. And this big gap, then you can go like, okay, this is second stage. When 9:30 really rips away from there and distributes down, you can trust that that's likely to continue. If we drop down to a low time frame, we'll probably see the same kind of framework that you can use, which I'll go over next, which is when 9:30 just rips off in one direction. If you know it's going to continue, a lot of the time it's hard to get involved. But if you just use the same kind of idea of, okay, all I'm looking for is for an intermediate term high. So we have a short term high here, it gets taken out, intermediate. Once you see that and it breaks low, you could either sell the next short term high here, or you can wait for that to break lower, and then you can just wait for the next fair value gap and get in on that fair value gap. It just really simplifies, like when you see an expansion from the 930 open, to be able to get in and get involved a bit easier. So this is NQU, yep. 05 to 09. This is just another example of a market maker model that's a bit different. But still has the same kind of principle. Where you have, so yeah, when you start like just seeing it as literally just the RTL and then second stage, it makes it really easy to identify it. So here we have 930 just here. It's kind of a bit of a mess. We had a news driver at 10. But then once we made this lower low, we had some SMT in here. And then we can start looking for first stage. So really clear short-term low, intermediate, and short-term low here. And then displaces up. And then you're just looking for an IOFUD, which we get there. And then it works its way into the draw. So really basic framework to not be looking for, okay, we have to have this original consolidation, has to have a first, second, smart money reversal, etc. Instead of looking for that, you can just be looking for, okay, well, I trust this as the smart money reversal, 10 a.m. news, SMT, etc. And then you've identified first stage, and then you can just go, cool, looking for IOFUD, done. Next example will be on YM at the moment. I can show how I was looking at price this week. So all week I was looking for, get rid of that, for 43,802. So just saying, that was my drawn liquidity for the week, and we just fell short. But yeah, so I was bearish all week. And then if we go back to Monday, we can start looking for the ways to get in. And so start with assuming that we know everything. We're expecting it to go lower. We have all these smooth lows. That's the first thing suggesting that's going to go lower. We have all these smooth lows. We then have our smart reversal at a key time with SMT probably. And then we have our short-term high here, intermediate, short-term high. And then you'll find, because if this is the lower time frame, this is a market maker model. And in the higher time frame, this is just a continuation towards the market maker, like the drawn liquidity. So you'll find that on the 1 minute, there'll be an IOFD just here that sends us into the draw. But the key thing is just seeing that you have the short-term low, short-term high, intermediate, short-term high, IOFD, sent. Then the same thing on, let's say here as well. Let's say this is the smart money reversal. And then we have a short-term high, intermediate, short-term high, IOFD. So just really just stripping it back and just looking at a really basic framework, not worrying too much exactly what it should look like, but just trusting what you're seeing. So
yeah, you can really use this to just literally frame trades off of, because you're just like, okay, this is what I think is happening, and then you just wait for time to line up, and then to give you whatever entry the structure, the market maker model structure is showing, and then you just enter off of that. Super easy.
Exactly, yeah. But yeah, just like really breaking it down to something that's really easy to spot and to trade. This was,
and if you line that up with like the weekly and daily profiles, that is money.
Yeah, so this was Friday's example. No, well, not Friday, Thursday actually. This one was really beautiful because it lined up beautifully with time of day. So this one we had the smart money reversal during the 9:30 open, during the opening range, so 9:47, 954, smart reversal, and then broke down because obviously we've got a fractal market maker sell model in here with a lower sell, short term, intermediate, short term, IFED, and hits there. But we're looking for a large move down. So what I did on this day is I recognized, okay, we've got to put in a short term high here. And then we came up, we stooped that short term high, put an intermediate, we broke down, came back up, put in another short term high to the right of it. So now we've got an intermediate term high. We've also got an intermediate term high here, making this a long term high. But the main thing is just this is intermediate, this is short term, we break lower. Now I'm looking for IOFED, or just like heaviness and second stage distribution. And in there, we get this, so we get this here. We have the high to the low, so we have a premium high here. We have 3 drives into that high, and then it breaks low at going into 130. So as you know, the 1400 hour and the 10 o'clock hour, that's the silver bullets distribution hour, and that's when you're likely to see that it will often align with second stage. So when I saw us break low at 130, displace low, and I knew obviously we're going into 2 p.m. and I'd recognise that we have a short-term intermediate, short-term high, displacing away. We haven't hit my draw yet, and we're about to hit the 2 o'clock hour. So I recognised that, and I was expecting this to be IOFED. And sure enough, 2 p.m. happens just here, runs back up, and then just displaces low. So when you can align it with a time of day, then that's key, and obviously time of week as well. If you've had like a Thursday or a Friday after, when you've got a really clear draw on liquidity and you're expecting it to be fast and reach up there, and if that aligns with second stage, then that's when you can expect the large range expansion days. Another example real quick I just thought of that was nice, fairly recent, back here. So this example here, so we had this drop into a 4-hour order block over here, sweeping out all the sell side, and then a nice move away from that. So the exact same thing here as well. You can just be looking for first stage. So we've got a short-term low here, got an intermediate term low here, and then to the right of it, another short-term low. And then you're looking for like speed into the draw. And obviously on this particular day, 930 just expanded in a straight line, went straight up. But you're looking for some sort of like IFED. And what's key about this day is this is a example that ICT actually talked about, where we had the previous day, that's the daily candle, and then we had this day here, which is like a really small range inside day. And so he says when you have that, and we've just taken this huge pool of sell side over here, you're expecting the next day to be expansion. And when you're expecting that, you want it to remain, it won't spend much time below midnight. It'll likely just have midnight and then just go from there. And so you can see that we have first stage. We now are expecting second stage. The framework on the daily chart suggesting that the next day is going to be a large range day. And it's already showing you the signatures that it's really wanting to expand. So that's another way it can come in handy when you're already expecting a reason why we should be moving fast for another reason, and then you can recognize that, plus this is also a second stage in a market maker model, then you can really trust when you see these big blow-off moves right at the open that, okay, it's for a real reason and I can trust it and just jump on board. And yeah,
it gives you a whole nother layer of easy it's not like this takes like an hour to analyze them, what's happening in the market maker model. It's just like you can look at the chart and it's pretty simple. So it's like a whole nother layer. Just like the problem with like the daily or weekly profiles is there are a lot of them. So it's like you always want to pick a few, but this is something where you could like pick for like a model, just look for the second stage or the IOFED or whatever, and just align that with everything else, and you're only looking for that, and it makes it super simple and
Exactly,
easy to
yeah.
trade.
And then if something starts happening that shouldn't happen in a second stage,
Then you get
um,
out and
yeah,
look for the
then
next day.
yeah, then maybe you're wrong and you need to look at something different. Um,
Yeah,
so
or just
that's
miss the day and stick with that one model. You know,
yeah, all that.
unless you're further all. Obviously, if you're further along, then like you have multiple models and you can quickly switch back and forth to your analysis. But yeah, just saying, if you're learning this, I'm telling this more for me because I'm like, I haven't studied this a lot. So I'm like, how could I easily, and all I'd have to do is just pick the things that I like in the market maker model that make sense and then align those with my same setups that I look for. And that's it.
Yeah,
I don't have to like do a whole analysis at the chart and if I'm wrong, try to figure out, what's really going on. It's more like I just take the loss and do another analysis tomorrow and the next day or whatever.
yeah,
Because then the time has passed at that point and I was wrong. So it's like, yeah. Anyways.
definitely, yeah. So there's just another example I remembered seeing and remembered like I didn't quite understand what was happening at the time, but like I remember this day we have the smart reversal. We have obviously a short term high, intermediate term high, short term high to the right, and then it drops down and it just remains heavy. Like it doesn't don't even know if it retraces to a premium. It doesn't. It just remains heavy. But when you know the framework of the market maker model, and obviously we had this original consolidation down here, really obvious, and more sell side below that, you can start using this framework to say, okay, well, I can identify the intermediate term high and the short term high. So we've had that. And even if you'd call, let's say, I'm not 100% sure if you'd call like this second stage or this second stage or both or what. Or I'd assume this is second stage and then this is something else. Like I don't know the specifics, but I can recognize that this is an intermediate term high and this is a short term, and I can recognize that we left the bulk of this fair value gap open, or we didn't even touch it, depending on what time frame you're looking at, and that we couldn't even retrace to a premium of this. We definitely has this really strong displacement lower. I'm expecting second stage distribution, and so when you're expecting all those things and it's the 2 o'clock hour, which is this is 2:25 right here, then you can really trust that, okay, we've had this huge drop lower, we should just be able to sell right here and watch continue down into drawn liquidity being this low down here. So once you can recognize like the reversal and the intermediate term high, and then you start seeing these signatures of heaviness and price, and then it's at the right time of day, then you can start using these entries with confidence rather than thinking, oh no, we've just hit sell side and it might come back up into this fair value gap. Because no, the time of day is there. It's already shown you it doesn't want to come up here. It's showing you heaviness and it's doing exactly what you want it to do. So,
Yeah. So what I'm taking away from like that, what you just said, is I already know how to trade the soups. I already know how to do all the, stuff when it's consolidating kind of. But on those moves where it's just heavy and you're afraid to get in, you could literally, I could literally study that, like the, I don't know what would
yeah.
you call that,
Well, if you
heaviness.
can, if
Study heaviness and when to trust that specifically and what are the signs, because then when I have my entry on, the soup, the first stage or whatever, and then I get my entry on the reaccumulation, and then it starts to deliver, I can literally like add in more and more and more, like pyramid in on
Yeah.
these little pullbacks and like get into a massive, basically like I'm smart money, and I literally accumulate this massive pyramid position for the big
100%.
move,
Yeah.
and then I deliver it, and and then it pulls back before the draw on liquidity, and then I add in my last size, and then
Bro,
it
you
hits the
bro, you're going to take
hits the
these
full.
concepts and you're going to run with them and like abuse them. You're going to abuse the fuck out of them.
Out of smart money.
Yeah, well, you're going to use
Yeah.
this framework and you're going to absolutely like abuse it and like really really get what it's worth out of it. I can just see it
Well,
already.
well, that's what's cool is like
Definitely, yeah.
if you just and you don't have to catch every little thing. It's just like, man, imagine all the work we're putting in every day to find a trade. Imagine if we actually squeezed, as much or at least a lot more juice out of that
Because there's
lemon that
always
we're
so much left in
so
it as
hard
well.
to grow. And
Yeah,
then you fucking instead of making 3R on a trade, you take 2 trades a week, but you make fucking 20R a trade, and then you're done. Like that's like how to do it.
yeah. Definitely, yeah. So the another really important thing that I really want to go over is something I learned from Market Maker Turbo on YouTube, and I paid for his Patreon as well for like a month. But his model is you have 830 with a red folder. And then you've got, I'll just do this without. So red folder news and without red folder news. If there's red folder news, you're expecting 830 Judas raise and shift. And if there's without red folder, you're expecting 930 Judas. So that's pretty much his model, and what he's looking for is any kind of like clean lows in the pre-market, for example, really dodgy looking, and then we're coming into 930. So at this point, what he's looking at is, okay, where's the liquidity? So he just zooms out and he'll be like, well, there's clearly some liquidity here. We've got some smooth lows here. There's a pool here. This is all liquidity. And then maybe there's a fair value gap up here or something. And he's thinking, okay, well, my model is that I'm looking for us to go to one side and attack the other side. And because he thinks that this is going to be the ultimate target, he's looking for that to that, essentially. And how he knows what's going to do it is he's looking for, if there's an 830 red folder, he's going to look for 830 to do the manipulation. So and then have a shift. And then if that's happened, then as soon as it happens, he can get involved. And then he'll be looking for 930. So let's say we have something like that. Then he's looking for, let's say 930 is happening right here. He's going to be looking for a 930 distribution. And then 930, that second stage right here. And then that's your fast move at 930. And then if 930, so I'll just use a vertical line, be the best way to do it. But if that's our like smart money reversal, if it's a 830 with a red folder news, you'd be expecting 830 to be maybe here somewhere. So you've got 8:30, and then it raids, has a shift, and then you might have 9:30 just here, and then 9:30 distributes. And then if it's not red folder news, then you would be looking at this is likely to be 9:30 where you have the smart reversal. So 8:30 might have been down here somewhere. Comes up, you've got the smart reversal, and then you'll likely have these first stage and second stage is going to be more than likely during the macros and during the first hour of trading. So a good example of that is today, Friday. On this day, there was no red folder news. If we zoom out, you can just look at what's happened. So we have this big gap up. We have all this sell side down here, a big pool of liquidity. We have another pool here. We have these relative equal lows, which we just tap there. Another pool here. So heaps of liquidity. This is just how he does it and how he views it. He just really strips it down to basic. He just zooms out, says, okay, where's the liquidity? We have a previous day high here, and we have smooth lows down here. There is no red folder today, so I'm expecting 9:30 to be the Judas. Sure enough, 9:30 moves in one direction. He's just waiting for it to turn around and have the change in state. You get your CSD there. Displacement lower, and then he's just looking to go short going into the draw. And then you can use, if we go back to another day, what day was there 8:30 news? There's another day here. Obviously 8:30, there doesn't look like there's any news on this day. But the same thing, you're looking out saying, okay, we've got these relative equal lows down here, all the sell size, and we have a fair value gap up here. And so he'll be looking at, okay, well, because you got the 9:30, you'll expect 8:30. Did 8:30 have a raid and shift? No, it didn't. So I'm expecting 9:30 to do that. You have this run up here, drop back down, and then he would just be looking for any reason to get short in here after hitting this. Obviously, in this case, we have another run back up and then trade over. But the basic idea is just using the 8:30 and 9:30 open. You can use it to anticipate market maker models, which usually form around this time, where you've got a really clear consolidation, various stages of accumulation. This is really just me throwing boxes and random spots in a chart, but you get the idea. And then using the economic calendar to anticipate when there should be a raid and shift at 8:30 or at 9:30. Be nice if we can find one with 8:30 news to show an example. But here's one. So we've got these relative equal highs up here. We've got this buy side pool up here, and let's say we get this SMT or something, and this is our 8:30 news. So 8:30, did it do a raid and shift? Yep, it took out the sell sides, and we got SMT. And then, okay, well, we're looking for 9:30 continuation. And then in this case, you can see that we have a short-term low put in, an intermediate-term low, it displaces away, puts in another short-term low, and then you can use the same kind of idea of the market maker framework to anticipate the IOPD and the first stage and all that. But yeah, the main point of that is just saying that if you have 8:30 news, you're looking for 8:30 raid and shift. 9:30, you're looking for 9:30 Judas and raid and shift. So here, no 8:30 news. And then we have the 9:30 Judas into sell side, and then go the other direction. So really basic stuff.
Yeah, that's exactly what I've been thinking this whole time. That's how I would use it, because just wait for the morning, wait for 8:30 or 9:30 to easily determine what to look for. Super easy.
Definitely, yeah. IFED, second stage. 29th of October. I think I've done. Oh no, that's right. Incorporating PD arrays. So XAU 29th of October. So, like I said before, like we showed this example where we had the second stage happening just here. So we've got the first stage, second stage. So I'll drop down to lower timeframes. So in this case, we were expecting second stage. It's already shown us that it's respecting the midpoint of this fair value gap. Drop down again. And so we're looking to incorporate what PD arrays we should expect at this time. So we've already seen the higher time frame IOFD, and then we have this lower time frame market maker model happening. So within the second stage, we have a smart money reversal here. We have a short-term low, intermediate, and then short-term low to the right of it. And now we've had a first stage, we're looking for a second stage. So when you have second stage, obviously you're looking for speed, and here we have a really nice propulsion block. So we have this order block here, just have that as an order block, and then digging into this order block and swooping below these relative equal lows, we have this down closing range here. So if we drag out the top end of that, if we're expecting a speedy delivery, we've already got the PD array you'd expect a fast delivery off of, the propulsion block. And it's also, this candle right here is 9:30. So the time of day that you expect a fast move, 9:30, into a PD array that you expect a fast move off of, the propulsion block, within second stage on the higher time frame, and then that's how you get to these really big moves, and you can anticipate what PD array that should hold for it. There was an example of that on NASDAQ last week, I think. I can't remember exactly what day though, but yeah, I think I've gone over like pretty much everything I wanted to go over. But yeah, it's like you can probably see, I don't have the perfect models and the perfect idea of exactly what it's meant to look like, but what I've found that works best for me is just being able to recognize the first stage and then anticipate second stage, and that's been really helpful for just knowing when to get in and when to anticipate strong or weak moves.
Yeah, the huge key with this is like time is everything. Like you'll just get lost in the market maker model unless you're literally only looking at news, be open, or like a kill zone, whatever you use for time. And otherwise it just gets so confusing, because that's what makes the market maker model seem to be so useful, is by using the context of the market maker model into time, because you're already expecting something to happen into the news or into like a Judas swing, or just like you laid out with that one guy. You're already expecting something to happen, but now if you're waiting for the news and now you have the market maker model also in mind, you can frame the Judas swing into the market maker model to like give you that where to buy, like which PD array to use, and like, you know what I mean, like which level basically to use because of the market maker model.
Yeah,
because that's the hard part for me, is like, yeah, like on that last example, it was like there was a few candles that went down into that fair value gap that showed respect of the fair value gap that we were talking about.
Yeah.
Which gave you confidence that might have been the bottom or the low. But you'd have to line up that low in respect of the fair value gap, also with time. And then that's when you would layer on the market maker model on top of that, because now you're like, okay, we respected that right into London Open where we swept the lows or whatever. I'm just making up an example.
Yeah.
London Open sweeps the lows, creates the order block, and then into the 8:30 news after London, we create those lows. News happens, sweeps out the the fractal smaller time frame market maker model, and then you can enter on that, or like you just said, with if there is no news, you wait for the open to get into the next whatever the next structure or whatever the next thing that you're seeing is,
Yeah.
and then that's it. Super
100%.
simple.
Yeah.
That's how I'm gonna use it. I'm not gonna like that's already how I already trade. I only trade the 8:30 news or the open, or rarely, the PM session, but yeah, or the close.
Yeah,
That's awesome.
definitely. Um, yeah. Just remembered one other thing that's important to go over is in a market maker sell model, when you only get one stage of distribution, then it's likely going a lot further than your draw. And this, you might remember, this was the day I caught that short, and I was really happy about it because it's probably the biggest trade I've caught top to bottom. But because we had the first stage of distribution and it just kept on going, it kept on rolling over lower and lower, I started thinking, okay, we're not just going down to original consolidation, we're going down here. And sure enough, it goes extra fast. So when you are in a market maker sell model and it's just not pulling back, it's just having one move down, then you can that means it's going a lot further than you expected. And then the last point I want to bring up, and this is something that really does stand out a lot, is how a lot of the time you'll find that the original consolidation will be at a institutional level. So, for example, I'll use the price note. So, for example, here we have. Oh, this has changed. This isn't. This be adjust maybe. There we go. So this was the original consolidation, and it was just above 40k even. So a key institutional figure, and that made up the original consolidation, and then we had this one reversal, and then drop back down for it. Another example would be on Nasdaq, just like today, original consolidation. If we move that up just a few points, you can see that's 21k 700. So when you have like a original consolidation, and including even on DXY, a lot of different assets, this is almost always the case. You'll have like at a key figure level, a level where institutions will be wanting to do business, and transactions where they want to invite buying and selling to happen. You'll have like 50s there, but usually at like a big figure being like a really high time frame, like thousands level or whatever. But that's
Yeah,
another confluence.
like like Nasdaq right now, dude. Right below 22K.
Yeah,
We got that big manipulation.
yeah, and another thing was when you have a new week opening gap or a new day opening gap. That's also a sign that it's planning on coming back to that level. So if you have a pool of liquidity engineered at a new week opening gap, then that's telling you that it's likely to come back there. Then at the same time, this is also once again like a institutional level, and a new week opening gap just below it. So showing you that it wants to come back there. And then same thing here. This is another like a low time frame market maker model. You have a new day opening gap. That's the purple box. And engineers a pull down there, and then it starts the market maker model. So by using new week, new week, and new day opening gaps, a and also institutional levels. If you see an original consolidation at that area, then that means it's a very high probability draw. It happens all the time in Nasdaq. Pretty
Wait,
much
can you repeat that? What did you just say?
when you have a if you have a pool of liquidity engineered at a new week opening gap or new day opening gap, and you think it's a market maker model, then that's usually you'll be right with that being the original consolidation and it coming back down there.
To soup it and go back up?
It just has to go there. Like I don't you don't need to worry about
Oh,
what it does after, but
oh,
you just want it to go
to
there.
use that. I'm just
Yeah.
confused because original consolidation means its price will like leave it and then come back and take it out, is what you're saying.
No. Well, yes. Essentially, I'm saying that it's going to be a draw at some point in the future, and if you are
Yeah, yeah,
already,
yep.
yeah, and if you're already expecting a model, this is another example here where we have um, a pool engineered at 21,500 even. And then we have the market maker model. I'll see if I can get a bit more detail on this because it's not very clear. Um, but yeah, falls short of the like it drops down to reaccumulates, it runs back up, has the smart reversal, and then drops down. We've got a short term high, intermediate, short term high, and then it drops down and hits the original consolidation. And what makes it such an obvious low, we've got these relative equal lows here as well, obviously, and then this is being engineered at a institutional level. Because they can help recognize like where price will go, and that's on. Um, I haven't looked at DXY in forever. Like I don't even know what it looks like right now, but the same things on here with. I'll just hide this. If we find a, let's see. But yeah, you get the idea anyway. You'll have like a really key level, and then you'll have price like engineer a pool there, and then do the model and come it down to it. That's the idea I'm trying to get across. But yeah, I think I've gone through pretty much everything, and yeah, hope that was helpful or like helps you like kind of know what I'm looking at.
Yeah, that was really good. My problem with it, because I just watched a few, videos on it. It was just like very vague, and I didn't see how it, like, everyone just explained like, oh, it does a smart money reversal and then it distributes. I'm like, cool. I already know that price does that, and like, cool story.
Yeah, it doesn't give you
But
like a practical way to how to apply it. Like how can you actually use this?
exactly. But then, yeah, now that you kind of went into detail about what typically happens in these stages, that's what's useful, because then you just pair that with, your trade that you're already looking for to confirm like the area you're looking to buy, or because that's been my issue, is been I'm always right about like the draw and liquidity like 90% of the
Hmm.
time, and I end up getting stopped out one or two times because I'm getting too zoomed in on my entry. Like there's lots of different reasons why. But if I pair in that, okay, for example, to expect like a Judas or like for us to sweep below, or to just like a continuation, fair value gap order block, it doesn't make a new low. You know what I mean? Like sometimes it's hard to know if it's going to hold or not. But if you pair it with the market maker model, then it's like, oh, well, we haven't had our second accumulation yet. Then it's like, okay, then that kind of clears up. Like, are we going to break below that original displacement on the smaller time frame? Or are we going to come back and just rebalance that and then go? Or are we going to literally take out the low and then go? Kind of like what happened to me on gold last week that I was messaging you about,
What day was that?
where gold and silver had that SMT into the close on Friday, and then they
Oh
both
yeah,
and then gold ripped, and then they both came back to take out that the new week opening gaps that they made,
yeah.
and then they literally ripped to the fucking moon right after that.
It's the exact same thing here, eh? Like, yeah, exactly.
And
Like,
I got taken out because of that. When if I had kind of had that model in mind of like, is this it? Okay, yeah.
yeah. So here's what I was looking at. Like in hindsight, I went over it and I had a look. And yeah, so this was obviously we both were confident in this being the low. Then we've got our short term low, intermediate, and then a short term low to the right of it. And so what I was looking at in here is how after we've had all this move in here that you got shaken out of, then you're looking for a second stage. And for second stage, you're looking for IFUD. And this is the draw up here. And then this is the exact same thing as we saw the other day on gold. In the other example, sorry. If we look at just find a fair value gap to use. But we've got a nice fair value gap here. And we're expecting second stage distribution. And then if we go drop down to lower time frame, if it loads, there we go. And then you're looking for the same thing. It's coming into a key time of day. We're at the 8:30 open, and it's already shown us that it's doing an IFUD because it can't get any below this. And then it has the displacement back into the range, and then it starts ripping away. But if you're going to anticipate, with this being 8:30 right here, if you're going to anticipate that this is second stage reaccumulation after first stage, then you can expect that we shouldn't drop really deep into this range. So when it starts showing you signatures on the low time frame that it's ready to go, you can just trust it and jump in and ride it all the way up.
Yeah, see, that's where I miss out on a lot of trades because I'm like, well, it's already kind of moved without me, and I would want the thing that you were just showing, I would want that to come all the way back down to that order block for me to make sense of it,
Yeah.
Not that original order block, but like the propulsion block on top of that.
Yeah.
Like I'd want it to come back into that because we just took out all those equal highs to the left.
Yeah, yeah, for sure. I mean, like, obviously in hindsight, it's a lot easier to see, isn't it? But
exactly.
I only sized this particular example and the last one on gold that I showed, or the other one where we had a similar thing, where we had the first stage, then a IFED and a consolidation, and then it distributes. That's something I've only really just started noticing, and like I've begun to see it more and more. So I think it could be something like the more we like look out for it and start seeing it, I think we'll be able to get quite good at recognizing it, and then if you can like jump into the most explosive move, and not be worried about it dropping down, that'd be the ultimate day.
Exactly, yeah.
But yeah, so yeah.
Do you want to send me a link to your Notion notes, maybe? I guess that would be better than sending screenshots.
Yeah, I'll send you. I'll send you a link to this or something, and then you can have a look. But this is really just what I wanted to talk about in this presentation, and I think I've gone through pretty much all of it. So,
sweet. Yeah, I'll have to do some more studying on my own to get super confident in all this. This is dope.
Yeah,
you did a good job, bro.
So yeah, thanks. Yeah, I'm glad it came across like for the most part all right.
Yeah.
Like I said, I wanted it to be like a bit more structured and like really, have specific examples for each thing I wanted to show, but it was kind of more on the fly, finding things as we went. But I think still came out all right.
Yeah, that was good. Sweet.
Yeah.
Well,
Sweet. I expect you to be buying like pretty much every single stage of every market maker model on both sides of the curve by this time next week, and
Yeah, that's
Running
the plan.
price, eh?
Yeah, that's exactly what I'm gonna do.
Easy.
Wait, so you recorded this?
Yeah, I've recorded it. Hopefully, should have recorded, I think.
Sweet.
And
Well, sweet. Yeah, I'm gonna have to. This is making me need to go and look at some videos about it just to get more detail.
yeah, no, definitely.
I I, I looked up that guy you said on YouTube, the Market Maker Turbo guy. I'm
Yeah,
gonna watch some of his videos.
yeah. He's the way he like talks about it. Like, way his teaching style is good because he makes it really basically all he's talking about is inefficiencies and liquidity, and he doesn't get real detailed with it. He just zooms out and says, "This is a liquidity pool." And so I think price is going to go there. So I'm just going to trade price there using order flow. I think stripping trading down to the Chrome and not trying to get super technical with things is really helpful with just having a framework that you can then add your really specific detailed models to. But if you have like a really basic fundamental framework to start with, then it makes it a lot easier to trade.
Yeah, I need to get better at that. I always get a good model going, and then I find something that starts to work really well, and I notice all these extra little details about it while I'm doing it, and then I get too lost in the details, and I end up missing and then taking losses because I'm not looking at the simple stuff.
Yeah,
Something I've been realizing I've been doing a lot lately.
yeah. It's like that meme that he's just like calling up his mate and saying, "Okay, are we buying? Is it a buy or a sell?" Like that's when you get really good at trading. That's all it is. It's not that all you're looking at is buy or sell, and you're not
Yeah.
really looking at all this complicated stuff.
Yep. 100%.
Yeah,
Well,
easy.
sweet,
Well,
bro.
yeah, sweet. Yeah, enjoy the rest of your Sunday evening, and yeah,
Send me
I'll
over
catch you
that
next week.
and if you can.
The Notion, yeah, I'll send you a copy of it for sure.